Welcome back to Mastering MHA MBA. This is Chapter 11, Part 2 of 3. In Part 1, we built net present value, the gold standard. Now we meet the three other measures you will actually hear in meetings: internal rate of return, payback, and the accounting rate of return. We will see what each one tells you and what each one hides. There are four methods in this chapter, and they split into two camps: the discounted cash flow methods, net present value, and internal rate of return. Both respect the time value of money. The two simpler methods, payback and the accrual accounting rate of return, do not fully discount cash flows. That difference is the whole story. The simple methods are popular because they are easy, but easy comes at a price we will keep pointing out. The internal rate of return is the discount rate at which a project's net present value equals exactly zero. Think of it as the return the project earns on the money invested in it. The decision rule mirrors NPV. Accept the project if its internal rate of return is greater than the required rate of return. Reject it if it is lower. The appeal is that the answer comes out as a percentage, which managers find intuitive. A project that returns 16% just sounds better than one that adds a pile of dollars. Take the same machine from Part 1. It costs $379,100 and returns $100,000 a year for 5 years. To find the internal rate of return, we solve for the discount rate that drives net present value to zero. For this project, that rate is exactly 10%. Since 10% is higher than our 8% hurdle rate, the project is accepted, the same verdict NPV gave us. When you're evaluating a single project, NPV and internal rate of return almost always agree. Here is where it gets dangerous. When you have to choose between projects, not just accept or reject one, the two methods can disagree. Internal rate of return is a percentage, so it ignores scale. A small project returning 30% might add far fewer dollars than a large project returning 12%. Yet IRR would crown the small one. Worse, a project with unusual cash flows, where money flows out, then in, then out again, can have two different internal rates of return, or none at all. The rule to remember: when NPV and IRR conflict, trust NPV. It measures value in dollars, which is what owners actually keep. The payback method asks the simplest possible question: how long until the project pays back what I put in? For our machine, divide the $379,000 investment by the $100,000 of annual inflow, and you get a payback of about 3.8 years. Companies often set a cutoff, say, anything that pays back in under 4 years is acceptable. Payback is genuinely useful as a rough screen for risk, because the sooner you get your money back, the less exposed you are to an uncertain future. But payback has two serious blind spots. First, basic payback ignores the time value of money. It treats $1 in year 3 the same as $1 in year 1. Second, and this is the big one, it completely ignores every cash flow that arrives after the payback point. A project that pays back in 2 years and then dies looks better than one that pays back in 4 years and then gushes cash for a decade. There is a patch called discounted payback, which discounts the cash flows first, but even that fixes only the first problem, not the second. Never let payback make the final call on its own. The fourth method is the accrual accounting rate of return, or AARR. You take the project's increase in average annual operating income and divide it by the investment. Its appeal is that it speaks the language of the income statement, the same accrual numbers managers are judged on in their performance reviews. But it carries the same flaw as payback. It ignores the time value of money, and because it uses accounting income rather than cash flow, it can be distorted by things like depreciation choices. Useful for understanding how a project hits reported earnings, poor for deciding whether it creates value. So which of these four methods are companies leaning on right now, in a world of expensive money and enormous bets? The answer has shifted in the last 2 years. Two updates from the field. When interest rates were near zero, payback felt old-fashioned. Money was almost free, so who cared how fast it came back? Once rates jumped, that changed overnight. As the cost of capital rose, measured payback periods stretched out, and finance teams responded by tightening their payback cutoffs and demanding quicker recovery. The logic is sound. When capital is expensive and the future is uncertain, Getting your cash back sooner genuinely lowers risk. The lesson holds though. Payback should screen projects, not crown them. Use it alongside net present value, never instead of it. The biggest live example of these methods is the AI build-out. The cloud giants committed more than $300 billion in 2025, and investors keep asking the same question these tools are built to answer. When does this pay off and at what rate of return? The methods are easy. The internal rate of return formula has not changed. The hard part, as always, is the cash flow forecast feeding it. Nobody yet knows how much revenue these data centers will throw off. That uncertainty, not the math, is why these are the highest stakes capital budgeting decisions of our era. Pull it together. Smart companies look at all four numbers because each answers a different question. Net present value tells you how much value, in dollars, the project creates, and it is the one to trust when methods disagree. Internal rate of return gives an intuitive percentage. Payback flags how quickly you're off the hook, and the accounting rate of return shows how the project will land in reported earnings. Four angles on the same decision, but only one of them, NPV, is built to answer whether the project makes the owners richer. Notice the thread running through all four methods. Every one of them is only as good as the cash flows you feed it. Get those wrong, and the most sophisticated formula gives you a confident, precise, wrong answer. So, part 3 tackles the hardest skill in capital budgeting, figuring out exactly which cash flows belong in the model, how taxes and depreciation change them, and how to handle the value of being able to wait. See you there.